So first, the election. Well, 120 million people voted, I believe. That's the largest turnout in, I believe, 100 years. I read that today. It surprised me. I hope it's right. Anyway, the markets are relieved, mostly because of what has happened in the Senate. Because the Republicans seem to have kept the Senate, we know that capital gains tax rates are not going to go up, and that there is no chance of the worst proposal of all, a tax on unrealized capital gains. The market seemed to be leaning in this direction, moving into the election, even though the polls were saying something different. So the market, in its wisdom, got this right. So in the context of fiscal policy and monetary policy, the market's making bets on the results of this election as well. In the case of big tech and healthcare, which benefited, I think what the market's saying, it's unlikely we're going to break up the big technology companies. And in healthcare, we are not going to move towards nationalizing the healthcare system at all. So that's good. We probably will still hear, as we always do, no matter what year it is, about drug pricing being a problem as the next administration takes hold. But that's nothing new. And in the world of innovation, we're focused away from areas really that are going to be impacted by some of the price sensitivity out there. As far as infrastructure and banks, they were hit. Infrastructure because it does seem like we will be in gridlock in the government, with the House being Democrat and the Senate being Republican. Maybe there will be an opportunity to cross the chasm in some way, reunite in some way. That would be very hopeful. But I do think that the infrastructure stocks have been hit here. I don't think it's thrown them off, though. I think everyone knows we need more infrastructure spending. And Mitch McConnell did say one of his top priorities was more stimulus. Now, I think he means that for the hardest hit areas of our economy, especially the travel and entertainment, hospitality part of the economy. But it is possible that that will include infrastructure as well. That certainly is a topic that could unite the various policymakers. As far as banks, well, mortgage rates dropped to a record low here right after the election. And that would suggest that the regional banks have issues, and the regional banks relative to the market dropped to a new low. So this means a yield curve that is flattening is bad. So long rates coming down relative to short rates. Short rates can't go much lower. Long rates coming down or staying down here is a problem for many of the regional banks and for most banks, actually. As far as capital flows, will what has happened in this election be more inviting to capital? I saw this week that Norway said it is going to be allocating more of its assets, this is a sovereign wealth fund, more of its assets toward North America, especially the United States. And that's interesting. I believe it's still the largest sovereign wealth fund in the world, if not the largest, one of the top. So that was very interesting. And that was even before the election. So there's a reason for that. We are seeing in Europe, with the second wave of the coronavirus, a panic, a shutting down. And I don't think this has affected Norway, but I do think there is capital flowing from Europe toward the United States as, Europe seems to find itself in one predicament after another. I would say they're overreacting to the coronavirus. That's just my take on it. The first lockdown didn't work. A virus is a virus. The weather is getting colder. And so we are seeing cases spike, much more so in Europe than in the United States, although we are seeing a resurgence here. As far as the fatality rate, however, in the United States, there's a slight increase, but nothing like the jump in cases that we're seeing. In Europe, it's a little more serious, to be sure. Um, Even in Sweden, which did not go into a lockdown, they are somewhat more concerned than they have been in the last 9 months, which is interesting.